riding shotgun with Richard. Let's chat about some income stuff this morning. We got sometimes there's lots of different sources of income for qualifying for mortgages. One thing we can look at, and I've done this for several buyers, it seems to be the ones that want to purchase a home first and sell their current home after, so they don't have to hassle with the contingent offer and trying to move, vacate and move into the new home at the same time, coordinate those closings, which we do those too all the time. But, to be competitive in certain homes and price points, you want a non-contingent offer if you can. So for certain individuals, one of which, if you're 62 and you have an IRA, this particular last one was an inherited IRA. So on an inherited IRA, you go off of the, excuse me, the original IRA owner's age for distribution. So if you inherited it from a parent, they're of age 59 and a half or older when they pass, then you can actually set up distributions on a monthly basis, and we can use that income to qualify. We have to have a 3-year continuance, so depending on how much is in that asset, that distribution amount needs to last for at least 3 years. Now, so we use that as qualifying income. So we might need a little extra because you're supporting maybe 2 house payments for a while till you sell. So we'll have them set up an auto distribution, get confirmation of it, and it may just float them for a few months and they can turn it off. So once you own the home, they don't require you to keep that distribution going for 3 years. It's just it has to have that continuance in the assets. So there has to be enough there that it could. So once a borrower purchases the home and owns it, maybe they keep it on for a couple months to float them while they're paying both house payments and getting their property ready to sell. And then once they sell it, then they can turn it off if they like, and take the proceeds from the sale. Have that happen a lot. Pay down the mortgage, sometimes pay it off. Just depends on their circumstance. So those IRA distributions are income. Obviously, if you're still working and contributing to an IRA, an employee won't let you set up auto distributions from an IRA that you're contributing to that's an employer IRA, unless maybe you've left that employer and you have a different IRA, that kind of thing. So we can do that. The other type of income that I use sometimes in this scenario, there's certain investors have certain rules and requirements, so it just depends on what type of loan we're doing. But if you have an asset, I've had this happen as well, where somebody does have maybe they have a stock portfolio that they don't want to touch. Maybe they have mutual funds, or maybe they have another IRA they don't want to touch and set up distributions for. We can do something called asset dissipation. So what that is, we take that asset. One investor has to be in a retirement funds. Another, it could be just standard liquid asset, bank accounts, stocks, bonds, that kind of thing. So we take that total sum and divide it by 240 months, and we use that as additional income without having to tap it, without having to liquidate it, that kind of thing. So sometimes there's certain things in the guidelines, if you know them. I've been doing this a long time. I know they change it all the time, though, so I do reference them quite frequently to make sure no rules have changed, things of that nature. We can generate a little more income to help qualify buyers. So I use asset dissipation a lot. I use new IRA distributions a lot. Things of that nature. So once you sell that home, when we're talking about selling and purchasing and selling after the fact and wanting to pay the loan down, and I've also had buyers that just don't quite have enough to pay it off, and they don't want to keep that higher payment because maybe they'd only put minimal down. Some cases maybe they put 5% down, or even more, but they want to pay it down. They want to lower their monthly payment. So what we do is we do what's called a recast. Conventional loans allow it. So you get into a home, conventional loan, and you sell your home, you want to pay it down by a couple $100,000 or something like that, but you want to lower your payment. You don't want to just pay it down and keep making a normal monthly payment. You can, and that'll pay off early, obviously, but to recast it, we send in a large principal reduction. It has to be 5,000 or more. We request the recast department to generate recast documents. They got to sign it. Obviously, they send the borrower some forms to sign for the recast, and they re-amortize the loan over the remaining term. So maybe you've got a 30-year fixed mortgage and there's 358 payments left. They re-amortize it based on the new principal balance over that remaining term to drop that mortgage payment dramatically. So we do that for certain borrowers that want that. So any questions, just reach out. Happy to answer them, and on income or recasting your mortgage, things of that nature. Have a great day, everybody.